Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm one of the portfolio managers at T2 Asset Management. Before we get started, just want to remind you that this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, a lot has happened in the last month and in the second quarter in general. The roller coaster ride continued throughout the quarter, which would make anybody a bit uncomfortable. So let's take a look and see what has happened. For the quarter, the S&P 500 index finished up about 3.8%. The entire quarter's performance can be attributed to the month of April when the market was up about 3.9%. May was a different story, though, when the market sold off big and ended up down about 6.7%. And then June came along and the market decided to rally back to a meaningful ending for the month, up about 6.9%. Now, some of you may remember back in the end of the first quarter, I was concerned about the run-up in the market and felt that the risk-reward characteristics of the market were a bit lopsided. So I decided to add some ETFs with built-in downside protection. I knew back then that if the market had continued to move higher, there would be a cost protection, but given the potential risk in the market, I was okay with that. Well, the downside protection did help us in May, but it did hurt us in June. When the pendulum swings so fast from fear to greed, risk management really doesn't matter, and that's exactly what we saw in June. So let's take a look and see what has happened in June and take a look at some of the market action. Here we have a chart of the S&P 500 index going back about a year. Back in September, we saw fear grip the market due to the Fed raising interest rates in 2019, or at least expected to back then, and as well as the elections that were going to be happening in November. The market sold off hard and in that quarter. And by the time Christmas had rolled around, the pendulum had swung right back up and the market took off pretty solidly. Fast forward to May, we saw the trade talks with China break down and the pendulum swung back to fear. Then came the Fed to rescue us and suggested that the rate cuts may be appropriate in the coming months. And again, the pendulum just swung back to greed. I wanted to share this with you so you could see how quickly things can change over a short period of time. If you really take a look at it, a lot has happened over the course of the last year. By now, I'm sure all of you have heard how great the markets are doing in 2019, and they certainly are. However, it's important to pull the lens back and see what was really happening over a longer period of time. Much like the previous chart we just discussed, this chart represents the performance of the S&P 500 over the past year or so. As you can see, back here in August of 2018 compared to the end of May of this year, you can see that the market has done absolutely nothing for a period of about 10 months. As a matter of fact, almost all of the one-year performance of the market happened here in June. Look, the market has done well this year. There's no question about it. But if you're only looking at a 3 or 6 month period, you can lose sight of the bigger picture and you could potentially fall into the trap of adding risk at inopportune times. So let's take a look and see what June really looked like here. As this here shows, for the month, all the major stock indexes did very well, with the Dow Jones Industrial Average performing the best in the month of June. Same story if you take a look at the first 6 months of 2019. The real surprise here is how well long-term treasuries have done. When treasuries are up 10+% in 6 months, you really have to ask yourself what's going on. Treasuries do not rally like that if the economy is running strong. There's a disconnect here between the stock and bond markets, and if you really want to know what's going on in the macroeconomy, you need to look at the bond market. Look into sectors of the S&P 500, we see a similar story. All sectors have done very well. The only sector, as a matter of fact, that's not in double digits for the year is the healthcare sector. So all in all, a pretty good performance across all sectors. So what's driving this market rally? Well, I think there's really two primary factors, trade and the Fed. In June, the G20 summit in Japan concluded with the U.S. deciding not to impose additional tariffs on Chinese goods, and that led the market to believe that there would be some deal made sometime here in the near future. I think the market is being a little too optimistic, though. Remember, Congress still has not approved the U.S.-Mexico-Canada trade deal, and that was agreed to back in October. The second factor is the Fed. The Fed has done a complete 180 in just 6 months. Back in the fourth quarter, they were still signaling rate hikes in 2019, and now all of a sudden we expect them to cut rates. The markets now feel that the Fed is their backstop and will do anything to support the market. However, this very well could be a situation where you want to buy the rumor and sell the news. If you look to history, when the Fed begins a rate cutting cycle, the markets tend to do quite poorly in the following months, and it makes sense. The Fed cuts rates when they see problems in the economy, so I wouldn't be surprised at all to see selling pressure after the Fed cuts rates here in July. Turning to fundamentals and my four-part framework, these are the four major components I look at when making investment decisions over both the short term as well as the long term. So let's take a look at each of these things independently. As far as the economy is concerned, I consider us to be in neutral territory. Not too hot, not too cold. GDP is still strong, employment is strong, and there's no signs of any inflation. However, looking at earnings, we're about to enter second quarter reporting season, and estimated earnings are expected to fall about 3% year over year. As of right now, 88 companies of the S&P 500 have issued negative guidance, with only 22 of them issuing positive guidance. If 88 is the final number, it'll be the second highest number for a quarter since 2006. Given the risk to the earnings, I'm holding a negative rating here in the short term. That very well could change depending on how second quarter numbers come out, but I think there is a risk that earnings become softer here in the second quarter. Looking at valuations, valuations have gotten more expensive with the forward PE ratio now above their 5 and 10-year average. With a forward PE of 17.1, it's not astronomical, but it isn't cheap either. And we could see some pressure on stocks in the coming months if earnings don't improve. For now, I'm neutral on valuations. And finally, the markets are betting that the Fed will save the day. The rate cuts expected here in July and potentially further rate cuts later this year. The pendulum has swung to greed, and I caution investors to be careful. As fast as the pendulum has swung to greed, it could just as easily swing back to fear. I'm neutral here because I still think that market participants are buying the dips, so any kind of pullback could be supported and it could be short-lived. So what do we do now? Where do we go from here? The Fed is expected to cut rates, but it may not be enough. It takes a long time for both rate hikes and rate cuts to work themselves through the economy. Regardless of what people think, the Fed cannot just change the trajectory of the U.S. economy with a single rate cut. Now, I know that some people may be feeling better about the market right now and may feel like they need to jump in with both feet so they don't miss out on future appreciation, but I'd caution investors not to chase these returns. There will be better opportunities to add stocks a bit later. As far as bonds are concerned, they are signaling a slowing economy, and the 10-year yield is now down to levels not seen since 2016. The performance of the bond market right now has been nothing short of spectacular over the past year. But remember, as quickly as rates drop, they can just as easily skyrocket, and that would be very painful for any bond investors. And finally, I'm not saying that you should give up on stocks by any means, but don't wait until it's too late to structure your portfolio with some protection. I know I've said this in the past, but holding some protection against market sell-offs is prudent risk management, whether you do so through ETFs or options or other vehicles. Yes, if the market rallies, protection will cost you a little bit, but if the market sells off, it'll help. You need to decide as an investor if you're more concerned about missing some of the upside or losing less in a potential sell-off. Thank you all for watching this month's video. I hope it was helpful, and if you have any questions about this or any other information, please don't hesitate to call or email me. Thanks again, and I will see you next month.